Good afternoon, ladies and gentlemen. I'm George Selgin, the director of Cato's Institute, the Cato Institute Center for Monetary and Financial Alternatives. I'm very pleased to welcome you all to today's Cato Book Forum, the subject of which is the book Borrowed Time, 2 Centuries of Booms, Busts, and Bailouts at Citi by James Freeman and Vern McKinley. I'd like to begin our discussion today by introducing our panelists, starting with the book's authors. James Freeman, immediately to my left, is assistant editor of the Wall Street Journal's editorial page and the author of the journal's Best of the Web column and newsletter. Vern McKinley, to his left, is an attorney, financial analyst, policy analyst, and author whose specialty is international central bank operations and deposit insurance systems and policies. Christy Ford Chapin is an associate professor of 20th century U.S. political and economic and business history at the University of Maryland, Baltimore County, and also a visiting scholar at Johns Hopkins, where she's working on her own book entitled Flexible Finance, Finance Capitalism and the Evolving Culture of Risk. Finally, Gary Stern was president and chief executive officer of the Federal Reserve Bank of Minneapolis from March 1985 all the way through August 2009, which I think is some kind of a record, isn't it, Gary? Second longest. He's also the co-author with Ron Feldman of Too Big to Fail, The Hazards of Bank Bailouts, which was published by the Brookings Institution in 2004. Thanks to all of you for taking part in this discussion today. I'm going to start by asking several questions of the panel, and after we're done discussing the book amongst ourselves, then we'll open it up in about 45 minutes to question and answer from the audience, after which we'll conclude and take part in a reception. So I'd like to start, James and Vern, by asking you a perhaps very obvious question, which is, why did you choose to write a book about Citi? And in particular, I'd like to know whether that was because you consider Citi's story unique or because you think it illustrates more pervasive problems with our banking system and policies.
Well, yeah, I decided to get involved because Vern said we should write this book. So maybe Vern should tell us, and then I'll say why I thought he had such a great idea and wanted to pursue it.
Fair enough.
Thanks, George, and Lydia, and Kristen and Gary for giving us an opportunity to talk about the book in a lot more detail.
Can you speak up a little bit, Vern? I'm not sure if it's your mic or me,
but I mean, the real genesis of the book, I think, was this whole idea of serial bailouts that you have multiple times over and over again. An individual institution, in this case Citi, had 5 brushes with death over the last 100 years since the Federal Reserve was created. James was working on editorials on systemic risk 8 or 9 years ago, and we crossed paths, and I was working to try to get documents on a lot of those issues, and this seemed like a pretty good issue for us to tackle. Of course, Citi isn't the only one that has come close on this matter. I mean, there's a couple runners-up. You've had Chase, J.P. Morgan Chase, and its predecessors have had these fits of instability. The Bank of America and Continental Illinois, which came together in the early 90s, have their own separate paths back in time where they had instability. But I think one reason to track Citi was because the lineage back in time is a lot clearer. You have from about 1812 through the 1990s, where there wasn't much in the way of mergers. It was mostly just organic growth, so it's an easy path to follow, whereas these other institutions, it was a lot more complicated path to kind of unwind everything. And then the last issue I think should mention is that the stories that we found as we dug into Citi's history were just perfect for James's journalistic storytelling approach. And I mean, that's not the primary reason we went with it, but once we kind of decided that Citi was the one, that was somewhat. That was a bit of an extra bonus for us that there were all these personalities throughout its history that lended themselves to storytelling.
And George, just I should thank you as well for having us, and we've benefited greatly from your work, and thanks for bringing these esteemed scholars in to talk about it as well. It is the classic too big to fail bank. It was the country's largest bank for most of its history, still now one of the largest. And I think what was really striking about the research Vern did was that you have this long period when it's an independent institution, when not only is it stable, it's so strong that it actually rescues the government on occasion. It becomes a magnet for deposits in time of crisis. And then roughly a century since it's been guided, heavily regulated, protected by the Federal Reserve, we've seen these bouts of instability. And I think that's what I think makes it a really important case study as we look at the too big to fail problem.
James, you anticipated a question I wanted to ask in pointing out that Citi, which we know is one of the largest banks in the country today, if indeed it isn't the largest, I think it is now the largest, is it not? In any event, it's in the top 4.
Right.
But you mentioned that in fact it was also one of the largest way back when it first started getting into trouble and being rescued. This was in the 1920s, if I'm not mistaken.
Right, that's right.
But was there, in fact, implicitly at that time, a notion of too big to fail? That is, can you say that the rescue of Citi at that time involved discussions of its size, interconnectedness, the sorts of things that are used to rationalize bailouts of large banks in more recent times? Or were the arguments distinctly different for coming to its aid?
We think of too big to fail. I think the experts on the panel would probably say that term really wasn't thrown around much till the 1980s, perhaps. I think what you do see in that period, though, which is really striking, is how right around the creation of the Federal Reserve, this goes from a model financial institution run by I would say a tough boss. They called him, similar to, a historian at the time described him as a microbe hunter, James Stillman, poring over the portfolio, looking at every credit, asking embarrassing questions of people who wanted to borrow money, very high levels of capital, very liquid bank. Then we have the creation of the Federal Reserve in 1913, and less than a decade later, after some disastrous overseas investments, they're borrowing heavily from the New York Fed. So I don't think too big to fail came into view for a long time. That term certainly wasn't coined, but we see there, I think, the real historical transition from a more or less free market in banking to one dominated and controlled much more by government. And the results have not been entirely positive. And I think we maybe want to talk about this, what this has given us in the more recent period, and what federal regulation by banking regulators yielded versus what they call shadow banking, meaning the parts of the financial system they don't control.
And in 1920, you actually had 3 institutions that were stumbling about that time in New York City. You had not only Citi, but you also had Guarantee Trust, and you also had Chase Manhattan. So I mean, I think that is definitely worthy of some follow-up research to see if there was any more detail, any coordination between the process for propping up all three of them. All three of them got discount window lending in excess of $100 million, which back in those days was quite hefty, and that was a big burst from about 1917 to 1920. And a lot of it was centered around New York in the discount window lending, if you look at it over time.
I think it's probably worth pointing out that this was a time when plenty of banks were allowed to fail. They were mostly very small. In the 20s, I think something like 5,000 banks failed, and almost as many again in the 30s, if not more. So that presumably size had something to do with it. But I wonder if the New York Fed may also be a little bit special in this story, and maybe we'll leave that food for contemplation by our other panelists. I'd like to pose a question to Christy next. In light of your work on attitudes toward risk and their evolution or development in 20th century American economic history, how do you see Citi's story, as Vern and James tell it, fitting into the general pattern of this country's, first of all, its general financial development, but particularly its evolving culture of risk? Is that story representative of general trends going on in the country, or is it perhaps a source inspiring some of those trends? What do you say about that?
Well, I think the book does do a good job of showing how at Citibank, particularly, had particular people at the head who were willing to make bad bets and run with low liquidity and not very well capitalized. What I'm looking at in my research is after World War II, of course, you have the banks are very cowed at this point, having gone through the Great Depression, and 20s and 30s, 15,000 banks are gone, they fail. So they're very conservative and careful coming out of World War II. But what I've seen that I was surprised about was because policymakers are very caught up with Keynesianism, they're very interested in pushing consumer credit. And this is when we have the banks changing a lot too. And this is something that Vern and James do a good job of showing in the book as well, how the bank changes. It used to be a place for the wealthy, the elite. They approach the bank and ask to open an account. But Citibank is actually on the forefront, even before the Great Depression, of moving out to the little people and opening up small accounts. And there is a little bit of lending in the 20s, but that's unusual. What you see after World War II that I find so interesting is you start to see attitudes towards risk changing, and partially there's a political story going on there with, for example, if you look at home mortgages, I think a lot of you are familiar with the FHA and the VA, the federally backed mortgages. The banks were thrilled to get this bailout in the